Hi, grade nines. This is Mrs. Boyens here, and we are going to look at credit sales for the start of term two. Now, if you can recall back to term one, we started the year off by looking at retail businesses and how to record the transactions. Specifically for a retail business, we looked at buying trading stock, how to record that in the CPJ, then selling of trading stock that we recorded in the CRJ. It was cash sales. We worked with the sales price, we calculated the cost of sales, and so on. So now we are building on that knowledge of term one. So in term one, we basically worked with a business that sells all its trading stock to its clients or customers for cash. So that means the customer walks into the store, he decides what he wants to buy, gets to the counter or the till and pays for those items immediately and takes the stock with him or her. Now we're going to take it a little bit further, and we're going to look at businesses that decide to offer credit or account facilities to their customers. Now, why would a business do that? First of all, I don't think we can ask for a better example as the times that we currently live in, especially with our coronavirus situation around the world, is the fact that people need at the moment perhaps lots of items or products, and they might not have the money for it. They might not um, get a salary at the moment, or maybe they got paid less than what they normally get paid for a month's work, and therefore they might need to buy products or items on account or on credit. Your business, as a business owner, you might start your business out as a cash business where you just sell to your customers on a cash basis, but maybe later on you can decide, listen, I want to attract more customers, I want to offer another service to my customers, and I'm going to allow them to buy on account or on credit. And obviously there should be an advantage for the business, and that's the reason why the business owner would offer that. One of the reasons why businesses do offer credit is that it would usually result in an increase in sales or turnover, so they will sell obviously more. And if everything is tightly controlled, the increase in sales will result in a higher profit. And which business owner doesn't want to make more profit for or in his business? Now, also as a business owner, you need to realize that there's also negatives to offering credit or account facilities to your customers. There's the risk that people would not pay their accounts, and it does happen, and we call that bad debts. And if you take accounting further in grade 10 upwards, you will actually learn that businesses have to make provision for bad debts. That means that as a business owner, you know that some people will not pay their accounts, and that you have to write that debt off. So it is very important to also understand and to realize that if I, as a business owner, am thinking of offering credit or account to my customers, I need to have really tight control measures in place in order for that to be a success. The retailer needs to make sure that he controls who gains access to that credit facility. Not everybody who wants to buy on credit should be allowed to buy on credit, and we'll unpack that a little bit more later on. Then also the amount of credit allowed. So if somebody has the opportunity or the option to buy on credit from you, for how much can they buy? And there's also a whole process that you have to go through in order to work that out. So say, for example, I've got an account with my ladies, and they will say, listen, your credit limit is 3,000 Rand. Then it means that is the amount that I'm allowed to buy on credit for, the maximum amount that I can owe my ladies. Then also the terms of agreement. That means how long does the customer have to pay back the debt. So some businesses, usually standard, like if we think of our retail stores, mostly your clothing stores like Edgar's and Truworths and Fashini and so on, Total Sports, they have the option of 6 months. That's usually with no interest added. So the price that you see is what you owe them. And then some stores also offer 12 months with interest. That means you can now pay the amount that you owe off over a period of 12 months. But because it's so long and there's lots of administration attached to it, they're going to add interest to the amount that you originally signed up for or what the product cost. So the credit customer is then in debt to the business, meaning it owes money, or the person owes money to the business, and therefore that person is called a debtor. Now, if you can recall, in the beginning of the year, we went through the whole accounting equation and all the elements, and we said that debtors control is an asset to the business, is one of our current assets. And it does sound a little bit strange because somebody who owes money to our business, how can that be an asset? The reason for that is we've already made the sale. So we've given that person the stock or whatever that person bought from us. So all we need to do is to convert that debt of the customer into cash. And that is what current assets are, is the conversion into cash at the end. So we do see the debt of a debtor as an asset. It's a current asset because that money is legally ours, or it's owed to us as the business owner. So a debtor is therefore someone who owes money to our business. If you have the PowerPoint presentation in front of you, you'll see that there's an activity 1 where we've just unpacked some of the definitions and terminology attached to credit sales, and it would be to your benefit if you work through that. I will most probably post it on Google Classroom, so you'll be able to access it there. If you are not part of my schools group, I can always email it to you, so we'll be in contact with regards to the activities. So when you as the business owner decide, listen, I want to offer this credit or account facility to my customers, you obviously need to work through this and think this through very carefully. So you have to weigh up the advantages versus the disadvantages. The same applies for customers. So some customers might say, yes, I want to make use of this credit facility because of the following advantages. And other customers might say, listen, no, I'm looking at the advantages, but there are also disadvantages. I'm rather not going to do it. So it's important to look at these advantages and disadvantages before we can continue. If we look at advantages of credit sales from a business's point of view, as we've mentioned before, there's then an increase in sales because there's more people or clients or customers who can make use of your products or services. As a result of that, the higher sales, we normally see an increase in the profit, which is very nice for any business to have. Then something that we also need to look at, which is quite advantageous, is the fact that the more I sell, the quicker my stock turnover. So that means the stuff that's on my shelves, I'm selling more and more, or my turnaround time is quicker, and that is obviously also resulting in higher sales and more profit for the business. Then something that could be a big advantage to your business if you decide to sell on credit, and especially if you're in the fresh produce market or sector, or you're selling products of sell-by date, is the fact that if you have more clients or customers who buy from you, you might be able to reduce your problem of wastage or products becoming obsolete because they are past the sell-by or use-by date. So that is a very nice advantage to look at as well. What are the advantages of buying on credit for a customer? First of all, obviously, it's nice to take something now and not having to dish out the money straight away. So the customer can take possession of the item without immediate payment. And sometimes it happens, you've now got a fun day at school tomorrow and you want some new clothes to wear, and mom or dad hasn't got the money right at the moment, but they've got a store card, and you can quickly pop into Legit or one of the stores and get yourself a nice outfit, and your parents can pay at the end of the month. So that is a nice advantage for the customers. And then we all know life happens, and sometimes there's an emergency or something very quickly comes up and things need to be bought, but there's maybe not the cash available for that. Perhaps you are chosen for a sports team, and now all of a sudden you need to get a new equipment, or an airline ticket need to be paid, or whatever the case might be. Then the availability of credit facilities is a nice one to have. And then also, especially with your more expensive items like equipment or furniture, can even include cars here, those things are expensive, and the normal person on the street there today doesn't usually have that amount of money lying around. Say, for example, you need to now purchase a new fridge because the refrigerator has broken down, and it's quite important to have one. It is nice to have a credit facility or being able to buy something like that on account and then pay it off over a number of months. But as with everything, as opposed to the advantages, there are also disadvantages. So, what would be the disadvantages for credit sales from a business's point of view? We've touched on it a bit earlier as well, and that's the fact that clients might not be able to pay their debt for various reasons. Some people are just not managing their accounts very well, but there might be a crisis, people get retrenched and so on, and they might not be able to settle their debt or pay off their account, and that can result in big losses for a business. The next thing that we need to look at is that it can create cash flow problems. Now, what does that mean? You, or as the business, it has certain expenses or purchases or also commitments that need to be met every month. And now you work out, as a business owner, you work out your cash flow projection for let's say, the next 6 months or the year, taking into consideration or assuming that your clients will pay their accounts at this time or this time. And now come that time and the clients do not pay their accounts, or some of them don't pay it, then it means you as the business will run into cash flow problems because you will not have the cash on hand. And that makes it very difficult to run your business effectively. And it has been the reason why some businesses have closed down in the past, is the fact that they did not have any cash available because the clients didn't pay them on time or didn't pay their accounts back. If I can just give an example here, a few years ago, you can even go read up on it, African Bank ran into huge problems because what happened was they gave credit to people who could not really afford to pay that money back or to service their loans, pay the installment on their loans. And African Bank ran into a cash flow problem. They had lots of people owing their money through loans, but those people were not paying the loans back on time, and that caused huge problems for African Bank. So as a business owner, you need to be aware of that and keep very tight control measures in place. Then something that we tend to forget is when we offer credit facilities and account facilities to customers, it creates a lot of extra admin. You will have to have account applications printed. So we're thinking of printing costs. You possibly will need to appoint more personnel because now you need to have a customer service desk that can deal with all the account queries or people who want to open accounts. Yes, I know nowadays lots of things are done digitally, but not everything is, and you will have to make provision for that. People who must answer the phones if there's queries coming in from clients, perhaps appoint somebody who must follow up on outstanding debt or debtors who are not paying their accounts on time. So you need to be aware of the fact that there will be lots of extra admin attached to offering credit facilities to your customers, and that might be a disadvantage to your business. Obviously, you need to pay those people's salaries, so it's a big expense, might be a big expense to the business as well. What would be the disadvantages for the customer? First of all, and that's just human nature, is if we know that we have that facility available, we have that credit available, we tend to overbuy or overspend. So we use that facility for the nice to haves and not necessarily for the necessities or emergency purchases, and that results in overbuying, and then it might be difficult for people to pay their accounts. And if, as a result of that, if you have customers who can't keep up with the payments or who default, and some months they pay and other months they don't pay, it can lead to them having a bad credit record, and that can affect future purchases. So I might have a clothing account with, let's say, Truworths, and I'm not managing it very well, and I'm not paying every month. And in 2 or 3 years' time, I want to buy a new car, perhaps. And then when the car dealer draws my credit record, which we'll get to now, they can pick up that I haven't been a good payer, and then I might not get the loan to buy my car. So that can be quite a big disadvantage for the customer or the consumer, and people need to think about that and also be aware of that. Right. Now, attached to offering credit or account facilities, in South Africa, there's quite a lot of rules and regulations that businesses and business owners need to adhere to. And that is really for the good and the benefit for both the business as well as the consumer. And one of the things that we're going to look at is the National Credit Act. Now, that became fully operational in June 2007 here in South Africa. And the National Credit Act was specifically created to protect the consumers as well as businesses in this whole credit granting scenario. Now, what is the purpose of the National Credit Act? First of all, it aims at credit providers granting credit in a responsible way. So it is your responsibility as a business owner to make sure that you are only giving accounts or credit to customers who can really afford it and who are in the position to pay that back debt. So you cannot just open accounts left, right, and center without doing your homework on each and every client who applies for credit. All right, it's also to educate consumers on the responsibilities of borrowing and making informed choices. Now, I think in the next slide, we'll look at an example of when somebody purchased something cash, what the price is, and what as compared to what it will finally cost them if they buy the same product on account or on credit. So it's important that consumers also know, listen, I really want this product, but if I'm going to buy it on credit, I'm going to spend a lot more money in totality on this product and item. Many people are not aware of that. So it's also to educate the consumer in that regard. Then attached to the previous point is to ensure that money that's borrowed or lent out can be paid back. I mean, you really don't want to have somebody buying on account or on credit from you, knowing very well that they won't be able to repay that money. What is the use anyway? It's just putting a lot of strain on the business as well as on the consumer. So it is one of the purposes of the National Credit Act to make sure that money will be paid back. Then it also protects consumers who are unfairly treated by businesses. And how this works is that the Act says that anyone has the right to apply for credit. Please note, it's the right to apply, not the right to credit. So say, for example, it's a Saturday morning, I just get up, put on my oldest tracksuit, I don't even comb my hair, no makeup. I'm off to the shops, and now I get there to Total Sports, and I think, listen, I need to actually invest in a few new tracksuit pants and tops, but the money doesn't look very good this month. Let me open an account, and then when I get to the customer service desk, the consultant there looks like me. She looks at me like in a very funny way, and I say to her, listen, but I want to please open an account here with you guys. And then she says to me, you don't look like somebody who can afford credit, and you won't be able, we can't open an account for you. There's no way that the consultant can do that. Nobody can be turned away. If I want to apply for credit and I want to open an account, I have the right to do so. Obviously, the store has to go through all the procedures and make sure that I can afford it, but they can't just outrightly deny me to apply for credit. So everybody has the right to apply for credit and must be treated equally and fairly in that regard. Then also the National Credit Act helps to provide debt counseling and put processes in place to those consumers who are battling to repay their debts. We see lots of advertisements with regards to that, where debt counseling businesses offer their advice and help as well, but there's also a provision made for this in the National Credit Act. Right, so here's an example. If you've got the PowerPoint presentation in front of you, you'll see there's a picture of a DeLonghi coffee machine. You obviously know what I'm interested in. And this was in one of the latest macro pamphlets that I found. So if you're a customer and you want to go into macro and buy this coffee machine, it looks like a very smart one. The cash price is 10,499 Rand. So if you go in, you've got the money, you pay for it there and then, you pay 10,499 Rand. Now, if you look just to the right of that 10,499, you'll see get finance. And there they tell you, if you want this coffee machine, but you want to buy it on account, from macro. This is what you're going to pay. 455 Rand. Now, gee, that sounds much better than paying 10,499. I think I can actually afford that if I don't have that big cash amount, but I can afford 455 per month. I'm going to pay that for 48 months. So that takes us to 4 years. So I'm going to pay for 4 years every month, 455 Rand. Okay, so even that for most people would not sound too bad. But if you add it up, can you see that at the bottom? What is the total amount that you finally would pay for this coffee machine? 21,814 Rand. People, it is basically double of what you would have paid if you bought this coffee machine cash. Can you see what the interest annual interest rate is? It is 20.25%. This is much higher than our current interest rate in South Africa, the prime lending rate or interest rate. So can you see what the cost of credit is? It is extremely high. So consumers need to be aware and educated on the fact that yes, we do offer credit facilities and account facilities. If you qualify for it, you can buy this item on account and pay it off over a number of months, but be aware of the fact that you're going to basically pay double for this item in most cases, if we look at these type of products. So this is just an example to show you how expensive credit can be from a consumer's point of view. So let's say now you've decided, okay, I'm going to offer account facilities in my store. How is this whole credit process going to work? How are we going to open an account for a customer? First of all, before a business will grant a person the right to buy on account or on credit, you as the business first have to see if that person is credit worthy. Now, what does credit worthy mean? It means, is this person able to pay back his or her debts? If we allow him to buy on account for 2,000 Rand, will this customer be able to pay that 2,000 Rand back? So that's very important. In order to find this out, the business has to look at a person's credit record. Now, what is your credit record, or what's a client's credit record? There you can actually find out how has this person paid off previous debts or previous commitments. Now, how do you find this out? You can draw a credit report or request a credit report from a credit bureau here in South Africa. There's quite a couple that you can contact. The main ones are TransUnion, Experian, CompuScan, or XDS. So obviously with the client's permission, you can draw a credit report. It's one of the requirements of the National Credit Act that you do that as a business owner. And from there, you'll be able to see if this person is credit worthy and how he or she is or has managed other accounts with other stores. Um, it is quite interesting to know that in South Africa, every resident has the right to one free credit report per year. So if you as a person would like to find out what your credit records say or says, you can actually contact one of these credit bureaus and draw a report yourself. They normally email it to you. You need to provide your ID number and a valid email address, and then you can actually see what would a business see if they draw a credit report from their side. So that is quite interesting to know. Right. So the customer will also be required to provide the following when applying to open an account with a store. Um, the customer's ID book, the business should ask for the original, not just a copy. They must bring the ID book or ID card, and then a copy can be made in store. This is obviously to make sure that you are talking to the person he or she is claiming to be, and to make sure that there's no fraud going on there. Then also proof of residential address. Many businesses ask that. That is normally also to see where this person lives, and then unfortunately if people need to be traced because they're not paying their accounts, at least there is some address to revert to and to try and find the person. Then the applicant or customer also needs to provide 3 months bank statements, as well as a copy of the pay slips. Many businesses require 3 months pay slips. Now, why is this important? I can go to a store and say, listen, I want to open an account and I earn 30,000 Rand per month. And I can even provide a pay slip. Now, people are very clever. They can design pay slips on basically any platform and print them out and present them as the truth, but they might not be a legit payslip, and as a result, businesses cannot just rely on the payslip that's presented. They must also check it against the person's bank account or bank statement. Why? In most cases, if you're a salaried person, so you work for a salary or a wage, that salary is paid into your bank account on a monthly, or if it's a wage, a weekly basis. But then the business can verify the pay slip against what has been paid into the bank account. So I can't say I'm earning a salary of 30,000 Rand, here's my pay slip. But when I compare it, or the business compares it with my bank statements that I also had to provide, there it shows, but I'm only earning 10,000 or 12,000 Rand a month. So it's important to ask, as a business owner, to ask the customers to provide the pay slip, original pay slips, as well as the bank statements. And it's a good idea to do it for 3 months. I know some businesses even require for 6 months, because I can provide you with last month's bank statement, but I could very well have been retrenched, or I could have only worked for a month, or took on a new job and my salary decreased a lot. So it's very important for businesses to get as much information as possible in order to make that decision on whether to grant credit to that client or not. So as a business owner one day, it is important that you ask these documents from your customer. On the PowerPoint presentation, you also see that there's something that I got off the internet for the Fushini group. It's quite a big group of stores, and this is what they require with regards to proving your income. There's a couple of things that you as the customer can provide. So it's quite nice to look at that as well. And then after all of these things have been vetted and scrutinized, if the business is satisfied, then it can enter into a contract or an agreement with the customer. And in this contract that's drawn up, the following should be specified. Firstly, the credit limit. So that's important to specify there. This customer is allowed to buy on account for a maximum of, let's say, 2,000 Rand. So that means at any given time, the customer cannot owe more than that amount. It can obviously buy for less, but it's not supposed to go over that credit limit. Then also the payment terms. That means how much time does the customer have to pay back the money. So as we've said before, many stores nowadays offer 6 months, and that's usually interest free in most cases. And then they also have the opportunity of you buying on account and paying it off over 12 months or 18 months, but usually there's some interest that's added on top of the amount that you bought for, because it takes the business more time and administration wise to manage and run your account. Then incentives or rewards. This is more applicable, I think, in a business to business environment where one business would buy from another business, and then they get some discount if the account is settled before the time. In most cases, it doesn't really apply to individual clients, but it could be. It's not entirely impossible to have incentives or rewards. And then also penalties. So say a client fails to pay at a certain date or pay the full amount at a certain date, then interest will be charged, but it needs to also be specified in the credit agreement. And as far as I could see from the research that I've done, at the moment, 2020 here in South Africa, it looks as if the maximum amount that of interest that can be charged per annum is 20.25%. I think it is also attached to the repo rate and the prime lending rate, but it looks to me as if it's 20.25% at the moment. Right, grade 9s, at the end of your PowerPoint presentation, you'll see that there's some work for you to do. I've included some extra resource material on the National Credit Act, just for enrichment purposes that you can read through. And then there's a short activity number 2 on the National Credit Act that you can complete in order to see if you are up to date and in line with what we've discussed so far.